In the next 10 to 15 minutes, we'll dive into a few things our team looks at in the markets that have historically led to market moves. Several of them are just fun historical facts that keep repeating, and others are usual real-time data series that our team keeps discussing time and time again. The good news is that virtually all of these indicators are aligning to say the typical first-year presidential term first quarter sell-off should be behind us and greener stock prices are ahead. However, investors, I want to remind you that we've anticipated that the first 2 to 3 quarters, not weeks or months in 2025, should see higher volatility than both 2023 and 2024. Of course, that's exactly what happened last month. Let's start with the fun facts, the ones that only insiders know. Well, first off, in my investment career, almost all major stock sell-offs have happened while I'm on a multi-day pre-planned vacation. This year, 2025, of course, has proven that factoid a money trade once again. Investors, I left for New York City on Wednesday, February 19th, which was the closing high for the S&P 500 at 6144, and the market promptly dumped. I then left for Florida on Friday, March 7th, and returned to the office Thursday, March 13th, which so far has been the closing low for 2025 at 55.21. Sometimes the markets are one big roller coaster. Say hey, Braden. Hi. Here we go.
Here's what you do.
Say hey, Braden.
Hi.
Sometimes it's just one big roller coaster ride. Folks, this isn't just a one-year thing. It's happened time and time again for the past 25 years. Maybe it's because I tend to take vacations in the seasonally weakest time of the year for stocks, mid-February through mid-March. Maybe it's just bad luck, but it's happened time and time again for years. And clients and financial advisors ask me why I never take vacations. Well, now you know one of the reasons, and also, money never sleeps even while you're on vacation. The good news for investors is that I have no significant planned vacation days until February 2026, almost an entire year from now. I know many of you might laugh at this, but if you're a trader, you trade things like this until they stop being coincidental. I have a great friend and mentor who is over 80 years old and still very active in the industry, running his investment business. He loves to trade stocks short term because it keeps him mentally nimble and because it's fun and profitable for him, even though he's financially secure. So what's the worst thing that can happen to a trader when you're out of the office? Yep, big price moves, particularly to the upside. As luck would have it, my friend also likes to play golf and take his family on really nice vacations for a week or two. Guess what almost always happens when he leaves the office and not trading his machines? Yep, almost always straight lines higher in prices with little to no pullbacks, leaving him missing out on the trading moves. There are a handful of other things I've seen time and time again that tend to be tells at market inflection points, both up and down. At market lows, the same friends call asking what my percentage odds I'm placing for an economic recession, or to tell them just move their IRA into cash because things don't look good. Investors, one of the biggest fallacies put out there in the last 10 years, along with the predictability and value of Fed funds futures, is sell-side strategists lobbing out recessionary odds like they're bookies. Folks, they're odds. Here they are. They're 0 or 100%. There's no 60-40. There's no absurd calls for models being 37 or 52%. Folks, it's 0, 100% in my book, recession or not. Are we going to have one or not? Not 50-50, anything like that. Which brings me back to the real-time data series we've discussed many times over the last 7 years, all of which are saying nearly the exact same thing. Good things are ahead, bad things are behind. It doesn't mean no volatility, but they do say that this is an ordinary first quarter decline in stocks, and the dip, however you want to describe that, what happened last month, should be bought for now. Quickly in order of importance from lowest to highest, in my opinion. Here are those things. First off, better seasonals kick in after mid-March, as mid-March is historically the seasonal low for the year in most first-year presidential terms, and also over the last 20 years. Take a look at the great chart from Carson Analytics. Historically, March 12th has been the low. Okay, investors, the second piece of data, real-time currency pairs like the euro-yen, which have been in an upward channel since the COVID lows and have historically signaled to investors to take more risk, not less risk, are rallying. This cross peaked in July of 2024 and sold off. and the S&P 500 quickly sold off about minus 9.7% back then. This currency cross peaked again in mid-December and sold off again through the end of February, and the S&P 500 dropped minus 10.1% from peak to trough. It's back in rally mode as growth is being stimulated in Europe and Japan is raising rates. This currency trend is positive. It's generally been a leading indicator for equities. The third real-time indicator, Dr. Copper is perking up and close to breaking out of a massive 4-year base at 488 per contract. Okay, admittedly, for years I've said I hate this saying about Dr. Copper having a PhD in economics. It's largely nonsense for the US economy and other developed ones. Why? Because emerging market economies and their demand have driven incremental demand for copper for decades now, not US construction or US demand, which has been the case prior to 2000 and the build out of the boom in China and India the last 25 years. That said, I find it almost comical that virtually every sell-side strategist who was wrong about 2023 and 2024 being much too bearish and who started 2025 too bullish on equities and the economy seemingly trying to catch up is now cutting their forecasts, just as Dr. Copper is saying they should be raising them for the second half of 2025. For what it's worth, for the first time this year, the purely mathematical driven volatility model I run and look at that has proven pretty darn precise and accurate since COVID says that 7,000 on the S&P 500 in the first quarter of next year, 2026, is now more likely, not less likely outcome. Fourth, the US dollar or DXY index has topped and is trending lower, not higher, as many in the financial press were parroting just in December. Same with the market priced interest rates. Both of these trends are better, not worse for earnings in the second half of 2025 and valuations in the second half of the year as well. Recall, it was only 3 months ago in late December, with strategist optimism for the year of 2025 running high and S&P around 6,100, the most strategists were declaring that interest rates were going to 5 to 6% and the dollar was going higher because of Trump policies. Both calls coming almost at exactly the wrong time at tops in both. Now, with both lower, those being interest rates and a lower dollar, somehow these same strategists have forgotten that these are now tailwinds for earnings in the second half of the year, this year, 2025. Okay, fifth and finally, investors, I leave the best for last. Investors, short-term, real interest rates. I'm looking at the fast twitch 1-year real rate, which I have found is a great proxy for shorter-term real growth expectations that look to have troughed near exactly when they have almost every year for the last decade, mid-March to the end of March. Investors, all these indicators, which have led rallies in stocks for this cycle, are all saying the same thing. Don't panic here. There should be a better place and a time higher to sell in the coming 3 to 5 months if you want to. So investors, if you're panicking right now, maybe your investment allocation is mismatched with your risk tolerance. Are there other indicators saying it should be better to buy than to sell here? Yes, there are quite a lot of them. AAII sentiment data is as bad as it was at the lows in March of 2009 at the spot-on lows of the great financial crisis. Volatility indicators are saying that much of the forced liquidation at hedge funds and in leveraged ETFs is over for now. The US money supply growth is now accelerating to almost 4% year to year, which is the fastest growth in 2.5 years. Investors, there are no guarantees in the stock market, and the first 2 months of 2025 are proving that lesson to those who just entered into the markets over the last 2 years and enjoyed plus 20% returns each year. It's been a sloppy, choppy mess, which, while uncomfortable to those watching day to day or week to week, as we previously warned, is not unusual, as the average year has a drawdown of minus 13 to minus 15% at least once, and higher volatility was likely to be the case for the first half of 2025. Did we see a minus 10% drop in less than 20 trading days, the fifth fastest correction in history? No. But here's the data from Seth Golden showing historically, swift and fast down has been followed by very profitable investment returns over the next 3, 6, and 12 months. I know that's not many data points, but 100% is a pretty high batting average in my book. Of course, no guarantees that history repeats again, but that's great data. I remind investors that even in the soft landing, Alan Greenspan-led 1994 through 99 stock run, in 1996, 3 years in, the S&P 500 dropped minus 11% peak to trough in the second quarter of 1996, broke the 200-day moving average for about 2 weeks, causing a lot of heartburn for investors, but ultimately went on to make new all-time highs in the fourth quarter of 1996 and over the next few years. A repeat of the gloriously boring and straight line up 2017 under the first Trump presidency was a very unlikely scenario in our work. The main reason we did not see a direct repeat coming in 2025 was the fact that in 2017, President Trump focused on one and only one thing: lowering taxes and getting that policy through Congress. Lower taxes equals lower friction on consumers and corporations, and shareholders love that. Republicans' linear focus on taxes caused the S&P 500 to move upward in 2017 in a near linear and historically low volatility year. Trump 2.0 out of the gate, it appears that Trump is going for the early shock and awe, taking on a myriad of policy changes in a rapid-fire manner: immigration, tariffs, foreign policy changes, and government firings and downsizing by the Doge. While potentially good for taxpayers and citizens over time, short-term do what? They all increase friction in the economy. They all increase costs to the economy short-term, and shareholders and financial markets have hated added friction. Is this max friction in the economy? The data behind the scenes says that it's highly likely it is, just as other strategists panic and tout out their recession odds. While other current policies in DC are anti-economic growth in the short term, real-time inflation expectations look to have peaked, while real growth expectations have troughed, just as others say the reverse. With most of the real-time data series flashing troughs and bottoms, I'm actually more optimistic thinking about the next 12 months, even as the markets are lower than 2 weeks ago. What if Trump is crazy like a fox? As a voter, you don't have to like him or his policies, but that isn't what investing is about. What if this time around, he and his staff have decided, let's tackle all the hard stuff first? The economy is pretty good, albeit overstated. Let's go all those friction items out of the way in the first 6 to 9 months. Let's get that done first, and then we'll focus on the easy stuff, the stuff everyone who's a shareholder or a consumer likes: lower taxes and lower regulation. Things that lower friction in the economy. Things that would accelerate the economy in late 2025 throughout 2026, so the GOP members can get elected or re-elected in the midterms in the second half of next year. What if, from an investor standpoint, he's crazy like a fox? Think about that for a moment. Soft landings in the economy do not guarantee no volatility. This time around, the Trump administration seems to be going for that early shock and awe, taking on those tough policy issues. However, here we sit in late March, and the good news, we're oversold and, historically speaking, nearing what is normally a low in both economic growth expectations in the first quarter, a seasonal low in the stock markets, and yes, a seasonal high in inflation concerns. Investors know that regardless of the path through the economy and the financial markets in the next few months, the investment team here at Oak Harvest will be here crewing the ship and adjusting our models where we can. We expect 2025 to be a very active year for active stock management. Until next week, have a blessed weekend, and remember, you have some legal inside information now. My next real vacation isn't for another 11 to 12 months, maybe more, and historically speaking, that's been a really good thing for stocks.